thank you for joining us today. As you can see title-wise, we're going to talk about the great income gap. It's going to be tied around long-term care insurance. Very important topic when you're talking about creating and utilizing a financial plan and an estate plan, because this is going to be one of the major expenses throughout your life and into the end of life. Everybody's got to pay attention to it because it's going to impact you in one form or another. We're very happy today to have Alecia Barnette with us. She's most tenured individual that is employed at Financial Independence Group, which is our financial marketing organization that we work with. She heads up and leads the long-term care division. It is actually our go-to for Brandon, myself, and Scott when it comes to long-term care. There are so many products out there on the marketplace, there's no way we can know everything that's out there. But we can take your situation, take it to Alecia. She'll run it through all the companies that are out there and present the best option for you. So we've got a great team behind us. Alecia, thank you for being here, and we'll let you have the floor.
All right, well, thank you so much, everybody, for coming today. I know a lot of people think this is a pretty boring subject matter for me, but I like to make it a little bit of fun. So if I ask questions, feel free to shout out an answer. I know I'm from the South, but sometimes I do talk a little fast, so if you need me to slow down, certainly put your hand up and tell me to pump the brakes. So before I get started, I always like to ask the room, what's the first thing that you think of when you hear long-term care? Shout it out. Money, yes. What else? Old. Not necessarily. Facilities, exactly. Thank you. Anybody been a caregiver? Just raise your hand. You don't have to. Wow. It's a lot. And today we're going to talk about how we can mitigate some of the risk, and we're going to talk a little bit differently about long-term care. So with that being said, I'm going to get started. There are a ton of misconceptions when it comes to long-term care. So we're going to go with 4 myths of long-term care. The first one is, it won't happen to me. So raise your hand if you think you're not going to need any, or let's do it the other way. Raise your hand if you think you're going to need some type of care. Okay, most of the women are raising their hands, and it's typically the men that don't. And most people think that everybody else is at a much greater risk of needing care. We're actually going to talk a little bit more about that here in a few minutes. So our next myth or misconception is Medicare or Medicaid have me covered. So how many people think the government is going to take care of us? I always get a big chuckle out of that. So there's actually a lot of common misconceptions when it comes to Medicare and Medicaid. For Medicare, you have to be hospitalized at least 3 days. It will typically pay up to 100 days of skilled care. And you have to be getting better. It really is short-term care, not long-term care. And then we have Medicaid. Anybody know how Medicaid works? So you have to actually spend down your hard-earned assets. If you're married, you could potentially leave your spouse impoverished. And it typically doesn't pay for care in the home. It pays for care in a facility. And I don't know about you, but I would rather receive care in the home if I were to ever need some type of long-term care services. So our next misconception or myth is that's what my savings are for. Many people don't realize how expensive it is. If you're taking notes or a mental note, you can go to longtermcare.gov. There is a ton of information where you can receive care. You know, how often between a male and a female, how long do you need care? And then there is a link that you can click on called Cost of Care. If you click on that link, it's going to redirect you back to the Genworth Cost of Care survey. You can put any city or zip code into this program, and it's going to tell you what the local costs are. And again, what most people don't understand is it's expensive. And if you don't have a plan, your money is your plan. So what I did was I pulled up some information in this area as to the local cost. So Winston is the closest. And since I'm blind, I have to come up here. So a nursing home right now on average, remember there are above average facilities, is $91.25 a month. Typically what you're going to see is home care and assisted living is about half the cost. So we're looking at $4,900 for assisted living and $3,900 or $4,000 for home health care. So again, if you haven't allocated something, you've allocated everything. And it's expensive. But these are today's dollars. What is that going to look like down the road if you don't need care for 5 years, 10 years, 20 years? It's going to be a lot more expensive. So there's a neat little slide. You can project out future cost of care. So what I did was I did 20 years out. Now for nursing home, we're looking at roughly $16,481 a month. For assisted living, we're looking at $8,800 a month. And for home care, now we're looking at $7,000 a month. So as we go through this presentation today, be thinking about this. If something were to happen tomorrow, which asset would you liquidate first?
The farm.
I hear you. Okay, so this is my favorite. Fourth myth. My family will take care of me. And I say this jokingly, but does your family know that? Now, how many of you have adult children? Raise your hand. Okay, leave your hand up if your adult children live close to you. Okay, so that's more than the usual. A lot of families now are spread out all across the country. Take my family, for example. I'm the oldest daughter in closest proximity. My mom has been twice widowed. My biological dad passed away when I was 4. My stepdad passed away at the beginning of the pandemic. She's 79 years old. I have an older brother who's 10 minutes away. I have a sister who's 4.5 hours away and a brother who's roughly 5.5 hours away. She got COVID roughly 8 months ago. So I went down, and she was very, very sick. So I went down, I live in Sherrills Ford, if anybody's familiar with that area. She's in South Charlotte, actually probably further than that. It takes me, again, 1 hour and 15 minutes to get to her. I went down every day for 2 weeks. I took her food, I took her medicine, I made sure my mom was okay. Ask me how many times my brother, who was 10 minutes away, went over to see mom. 0. And I love my brother. If he was sitting right here, I would say it in front of him. He is simply not a caregiver. He's going to go over and do the heavy lifting. He's going to cut the shrubs. He's going to fix the electricity if it breaks. He's going to change out the toilet. He is just simply not a caregiver. What is that going to look like when mom actually needs care? Here's something to think about. Long-term care does not bring families together. It tears families apart. And we'll talk a little bit more about that in a few minutes as well. All right, so again, I said I was going to talk a little bit differently about long-term care today. So what's the goal when you climb a mountain? Anybody?
Get to the top.
Most people would say to get to the top. Actually, it's to get down the mountain successfully without breaking your neck and without breaking your back, right? What goes up must come down. So a lot of baby boomers started retiring in 2017, and they've gone through what we call the accumulation phase. Saved, saved, and saved, right? Well, once you retire, what happens? Now you're going to spend. You're going back down that mountain. That's why you're hearing a lot about retirement income and retirement income planning. So, what are some of the issues when going back down the mountain during that, what we call that distribution phase? Anyone want to take a stab at it?
Taxes.
Taxes, yes, I need to add that to my list. That's a big one.
Stability.
Stability, absolutely. How about having enough retirement income? We're living longer. Are we going to outlive our assets? How about market volatility? Anybody seen any of that lately? Healthcare cost. More specifically, an income stream to pay for some type of care. So in your retirement years, what would be the reason that your income needs suddenly skyrocket? Say you're living well on $100,000 a year, and all of a sudden you have to take an additional $70,000 on top of that. What would cause that to happen? Most would say some type of health issue, right? If you're married or not married, what if you or your spouse become sick and needs some type of assistance? Where would you get that additional, in our example, $70,000 a year? Again, which asset would you liquidate first? So when your income needs suddenly skyrocket, where do you get the income to fill the gap? So most people are going to liquidate conservative assets, things like CDs, money sitting in the bank, annuities, managed accounts, cash or cash equivalents. Long-term care is an income issue, not an asset issue. All right, so will this affect your retirement income plan? Again, if you have to take that additional asset to pay for care, is your retirement income plan going to be disrupted? Will your assets last? So this is a diagram of what we call the great income gap. So say you're 65 and you retire and you're living well on $100,000 a year. But at age 75, you begin having some health issues. Most people can absorb some of that cost. But what happens at age 80 if you have a diagnosis of Alzheimer's and you need care for 10 years? That is what we call the great income gap. So what are some of the concerns, speaking of Alzheimer's? 6.5 million Americans age 65 and older are living with Alzheimer's. 1 in 9 people over the age of 65 have been diagnosed with Alzheimer's. Check this out. 1 person every 33 seconds is diagnosed with Alzheimer's. We got a problem, don't we? By 2050, they're saying 12.7 million Americans are going to have Alzheimer's. Hopefully, they come up with a cure, because we're definitely going to be in for a big problem. All right, so I asked you at the beginning to raise your hand if you thought you would need some type of care. So here are the actual statistics. 70% of people over the age of 65 are going to require some type of care. In fact, 1 in 5 will need care for 5 or more years. Here's the problem. Most of you think you're in the 30%. And if you think you're in the 30%, you don't put a plan in place. But what we know is most people who've invited loved ones into their life and promised to take care of will do something to help mitigate the risk and the consequences of not having a plan in place. Oftentimes the spouse will take care of you because maybe they'll feel obligated, and if you're not married, maybe other family steps in. It's typically the oldest daughter in closest proximity, right? She might quit her job and move in with you, or maybe you move in with her. Your life doesn't end, someone else's does. And again, long-term care doesn't bring families together, it tears families apart. Again, as I said, what's going to happen when my mom needs care? I'll probably be my mom's plan. We were in a pretty bad car accident when I was young, and she can't qualify for a long-term care solution. Do you think that when we're sitting around the Christmas table or at Thanksgiving that there's going to be some resentment because maybe I'm doing more of the caregiving than my family members? Maybe my little brother's telling me how to spend my mom's money? And where am I going to be in that stage of my life? I have a plan simply so my kids will talk to each other when I pass away, and so they can supervise the care rather than provide the care. Long-term care solutions are really family first. It is a love solution. It does affect your finances, but it's family first, finances second. So how do we mitigate the risk? There are 2 main types of long-term care solutions. And by the way, there are many. These are just 2 of the primary ways to fund a plan. A traditional long-term care and asset-based long-term care. Anybody heard of traditional long-term care? Raise your hand. Okay, a few of you. So I like to call that the old long-term care insurance. I also like to use the analogy renting versus owning. Traditional long-term care insurance is like renting. It is the cheapest way to buy the most amount of long-term care. And it's a good way to mitigate the risk. However, You can pay for it and never need it. So if you don't use it, you lose it. Your rates can also go up, again, like renting. And there's no exit strategy. Whereas the asset-based long-term care is like owning your plan, and it's written on a life insurance or annuity chassis. And you have a benefit whether you live, whether you quit, or whether you die. So what is an asset-based long-term care solution? This is a concept, so if this is where your portfolio, most people have conservative, moderate, and aggressive assets. And as we mentioned before, I meant if something were to happen tomorrow, people typically take from the conservative assets first. So the government has allowed certain life insurance or annuity policies to be accessed while alive, tax-free for long-term care. So we could potentially take something out of our conservative assets and we can fund a life insurance or annuity policy. But if you need care, that money's going to come out tax-free for care, and you get additional funds to pay for long-term care expenses. I like to call it tax efficient and pennies on the dollar leverage. So how do we fund an asset-based long-term care plan? There are 4 main ways, but there are others, and we're going to talk about those. The first way is highly appreciated non-qualified annuities. The second is cash or cash equivalent. I like to call it your rainy day funds. You can even use something like a reverse mortgage to fund it. Then we've got qualified dollars. A lot of us have a disproportionate amount of money in retirement funds, 401ks, 403bs. We can actually utilize those funds to put into a solution. And then last but not least, income. Not everybody's in a position of dumping in a lump sum, or maybe they just don't want to. You can use income to fund a plan, just like traditional long-term care or homeowners or car insurance. You can stroke a check over time to fund the plan. And typically you can see that done anywhere from 5 years, meaning you pay once a year for 5 years, or monthly or quarterly or semi-annually. At the end of 5 years, you're finished. All the way, you can stretch those out to your lifetime, paid to age 100, and many ways in between. So we're going to go through some case studies to help you understand these funding opportunities. Our first example is a existing non-qualified annuity. So what happens is, again, the government has allowed certain annuities or life insurance to be accessed while alive tax-free. So here we have an example of a 70-year-old male and 70-year-old female. He has an existing annuity of $150,000. If that were to have started at 50 and grown to $150,000, anybody know what happens when you start taking money out? You have to pay taxes on that money. So we can reposition that into a long-term care annuity that's going to provide tax-free long-term care purposes. So just by moving it from our left pocket to our right pocket, in that example, that $100,000 gain will come out tax-free if you're using it for long-term care services like home health care, assisted living, nursing home, adult daycare, hospice. So what does that look like? It's going to give them $60,132 a year per person, and it's actually a monthly benefit, but I wanted to show you the significance. Tax-free for care. So each person has $5,011 a month, and every dollar they put in, they get $3 for long-term care. So $150,000 is going to give them $450,000 day one tax-free for long-term care. I like to call it a tax-free long-term care bank account. You can draw up to $5,000 a person until that long-term care bank account is gone. If you do the math, that's 7.5 years shared between the two of them. But what's lovely about that is you can utilize one person's annuity to fund 2 people's long-term care. And again, pennies on the dollar leverage. But guess what happens if you never need care? Your $150,000 or whatever it's grown to will go to your beneficiaries. So again, you're owning your contract versus renting it. If you don't use it, you don't lose it. Does that make sense to everybody? Any questions before I go on to our next solution? Okay, all right. Our next solution is, go on to this one, is cash or cash equivalent. So if we have CD money, for example, or money in the bank, we have a 60-year-old couple, we can actually put that money into a life policy. So think of that base policy as nothing more than life insurance, a death benefit. So we can put that in, and that's going to give them $104,000 per person lifetime income stream to pay for care. Again, lifetime income stream to pay for care. This is true longevity protection. So if you needed care for 5 years, 10 years or more, that's going to cover that longevity risk. If both people needed care, that's going to give them $208,000 lifetime income stream to pay for care. And it does pay out like the other solution on a monthly basis. I wanted to show you the significance of that tax-free income stream to pay for home care, nursing home, assisted living, etc. It would take 52% return on an investment to give you a lifetime income stream of $104,000 a year.
Where's it coming from?
It's coming from the life insurance policy. So you're repositioning it into a life policy that has a long-term care rider included. So that lifetime benefit is where it's coming from. And these are not investments. Let me be real clear. This is a long-term care solution on a life insurance chassis. If both people needed care, it would take 104% guaranteed return on their money to equal that equivalent of a lifetime income stream of $208,000. Did I see a hand in the back? Yes, sir.
On this policy, if you already have an existing condition, are you able to acquire this?
That is a great question. So almost, and I'm saying almost because there are some guaranteed issue products out there, but most of the solutions that I'm talking about today have some type of underwriting. The life insurance policies have more underwriting than the annuity policies. The annuity policies tend to be more liberal. For example, the solution before this, you can have cancer, be receiving treatment, and you can still qualify. It's really not a one-size-fits-all approach. There could be 15 different solutions in here for 15 different people because it's health and wealth that buy these solutions and how you're funding the plan. But to answer your question, there is some underwriting. Most of these are simplified underwriting, so they take on more risk than some of the traditional life insurance policies. But that's a great question. All right, so if they wake up an angel and never need any care at all, this is a second to die death benefit of $288,917. So could you get a bigger death benefit if you put this in a plain vanilla life insurance policy? Absolutely. You're buying this for the long-term care benefits, and oh, by the way, if you don't use it, you don't lose it. I think your beneficiaries would be pretty happy about that $288,000 death benefit. But most importantly, if you need care, you have pennies on the dollar leverage for long-term care services. Any questions on this solution? All right, yes ma'am.
So, am I understanding it correctly that if you bought a $200,000 annuity?
This one's life insurance. The previous one is an annuity.
Okay, life insurance. You would get both the long-term care benefit possibly and a death benefit possibly?
Great question. So she asked, for those in the back that maybe didn't hear her, you get both the long-term care and the life insurance. So the way that these policies work is think of it as a high deductible catastrophic plan. If you need care, this is like a timeline. The base policy is your death benefit. You're going to use the death benefit first for long-term care services. Once you exhaust the death benefit, the lifetime, it's called a continuation of benefits, kicks in. So if you need care and you use up the death benefit, there is no more death benefit. If you don't need care and you pass away, the death benefit passes to the beneficiary. If you use $100,000, for example, and then pass away, then you have an $88,000 death benefit. So again, high deductible catastrophic plan. But remember folks, if you don't have a plan, your money is your plan. This is a more tax efficient way to pay for care. And again, pennies on the dollar leverage. I hope that makes sense. And that was a great question. Yes, ma'am, in the back.
Okay, this example, is it for a couple?
This particular one is for a couple. You can do one for an individual or you can do a couple. So this,
$200,000 would be for the couple.
yes, ma'am.
Thank you.
Yes, ma'am. Any other questions?
So how does it get to the 288,000 death benefit?
So since it's a life insurance policy, she asked, how does it get to the $288,000 death benefit? So life insurance is based on age and health. So for this age group, this is the death benefit that it would give you based on their current rates. The older you are, the less life insurance death benefit you get. So if you were, for example, 70, your long-term care and death benefit would be less. Great question.
It just seems like if you're buying 200,000, you would get 200,000. So is there some kind of internal rate of return? that's
Yes,
giving you
ma'am.
More money as a death benefit than what you bought?
Yes, ma'am. So it's not put in 200, get 200 out. It's put in 200 and depending on your age and the insurance company's internal cost of insurance would depend on what your death benefit would be. Most of these are going to give you out what you put into it if you die and don't use it. It's really not built for the life insurance. It's built for, oh, by the way, if you don't use it, you don't lose it. So you're not going to see lots of growth in the annuity and you're not going to see really big, huge death benefits. But that's a great question. Does that answer your question?
I think so.
Okay.
Thank you.
Yes.
If there's an existing life insurance policy, can you add on the long-term care?
Great question. She said if there's an existing life insurance policy, can you add in the long-term care? So you can 1035 exchange life insurance cash value into these plans. You can do life insurance to life insurance, or even let's say you have an old life insurance policy and you don't need the death benefit anymore. You could use the last solution. You could put it into the long-term care annuity. And again, you can cover 2 lives with one person's life insurance policy in that particular annuity policy, excuse me. Great question. So yes, you
Would
can.
that be, I mean, if you're not qualified for a life insurance policy now, but they can't drop the one you have.
That's correct. If you wanted to, for example, try to apply for one of these solutions, you leave your life insurance, put, and once you get approved, then we do what's called a 1035 exchange into the new plan. And again, if you can't qualify for the life insurance, you could potentially qualify for the annuity because it is more liberal. So that's a great way to fund a plan. Yes, sir.
Can you do both of these?
Yes, you can. You can do life insurance and annuity. You can couple them together. And if you, for example, only needed a portion of one of the policies, you could keep the other policy intact for the death benefit, or you could turn them both on at the same time if you needed care. Great question. Any other questions before I move to the next solution?
I got a question here for you. What if you exceed $8,667.50?
Great question. Then you are going to pay out of pocket. So I don't typically recommend covering 100% of the risk. What I typically recommend doing is, as a starting place, is let's at least cover 50% of that high-end average risk. And that'll typically cover 100% of home care and assisted living. Meaning if cost of care for a facility is $8,000 a month, let's start at $4,000 a month. Because here's what I know. I want to receive care in the home. That doesn't mean that I'm not going to go into a facility one day, but that's my wishes. So I'm going to at least start with that cost. And then you can dial it up or down based off your comfort level and how much of the risk you want to cover. Does that make sense? But if you have a plan and it's $4,000 a month and the cost of care is $5,000, then yes, you've got to pay. Think of that as a co-insurance or almost like a deductible. You do have to pay that out of pocket.
But normally you're filling that gap. with
That's right.
Pensions, Social Security, departmental distributions, whatever it happens to be.
Exactly. Now, there's 2 types of policies. There's reimbursement and there's indemnity. For reimbursement policies, once you qualify from your doctor, not the insurance companies, then there is typically an elimination plan or elimination on each of these policies. That's going to depend on what solution it is. But this one, for example, is if you need care, you have a 0-day elimination in the home, meaning care starts day one. If you go into a facility, there's a 90-day elimination, meaning you got to pay out of pocket for 90 days. And this one, if you have at least 90 days of home care, it waives the facility elimination. For reimbursement, you either have to pay the bill and send it in and get reimbursed, or you can have, this is what I recommend, is have the care provider basically bill the insurance company and assign the payment directly to the care provider. The other type of plan is an indemnity plan, and they just send you a check and you can do whatever you want with it. Now, if I would caution you, both ways are great ways to do it, but be careful with the cash plans, because if you don't have good family dynamics, what is that going to look like? Are they going to be arguing over the money? Are they going to take you out back and hose you off? And I say that jokingly, but just, be cautious when it comes to that. All right, any more questions on this example here? All right, let's move on. This is the most complicated, so try not to get caught up too much in the details. I just want you to know that if you need to or you want to and you have a disproportionate amount of money in qualified funds, you could utilize those to pay for these type of solutions. This is the first thing I want to tell you too, so I'm going to say it real loud for everybody in the back. You are never going to get out of paying Uncle Sam. You are always going to have to pay taxes on these dollars, unfortunately. But what we're going to do here is we're going to provide you a way to spread that tax liability out, pay the taxes while they're on sale. If you're old enough, you can satisfy required minimum distributions. But most importantly, you're going to get tax-free leverage for long-term care purposes. So in this example, we have a 70-year-old male and a 71-year-old female. Now, I know you don't have to take RMDs now. I think it's 75. Am I right? Is there 73, 74? Anyways, moving on up. But what we can do is we can reposition. Let's say they have a $200,000 IRA. We can move that from our left pocket to our right pocket. The insurance company is going to provide us with a 25% bonus on our money. Then they are going to turn on an income stream or an income rider to fund a 10-pay life insurance policy. Again, I know that is a lot to digest. Think of this as the McDonald's Happy Meal. You're just moving that $200,000 in the McDonald's Happy Meal. They're going to turn an income rider on to pay for the life policy. That bonus and that income stream that comes out is going to be $25,000 a year for 10 years. Again, you are never going to get out of paying Uncle Sam. That $25,000 is a taxable distribution. So you will be 1099 at the end of the year. And I don't know about you, but does anybody think taxes are going to go down? Raise your hand. So taxes are on sale. What we are doing is we are paying taxes while taxes are on sale, and we're spreading the tax liability out over 10 years. So what does that $25,000 buy for this couple? Notice the timeline looks very similar. It's going to buy them $63,000, I'm going to just round, a year per person, lifetime income stream to pay for long-term care. If both people need care, now we're looking at a $127,000 lifetime income stream. Now, if they wake up at age will never need any care, there is a tax-free death benefit of $177,000. So is that more than what they put into it? Nope. Anybody know what happens if they pass a $200,000 IRA to their kids now? They have to pay taxes on it. You're giving your kids or grandkids or whomever a gift of a tax-free death benefit. You're paying that tax for them. Does that make sense so far? So again, I know it's a little bit more complex, but just know that you can use qualified money to put into one of these solutions. This is a combination of an IRA and a 10-pay life insurance policy.
Combination of what?
An IRA, so we're moving it from wherever it sits into an IRA. And that IRA is going to turn on an income rider to fund a life insurance. So it's a combination of an IRA and a 10-pay life insurance policy.
10 pay?
10-pay, meaning they're going to pay the premiums for 10 years, and then it's all out of the IRA and all of it's in the life insurance policy. But guess what? You get those long-term care benefits after that first $25,000 payment. So if you need care in year 5, you get the full $63,000 a year for long-term care purposes. Yes, ma'am.
What if you don't spend the entire 63,000? Say you spend 20.
So the way that this works, this is a reimbursement plan. If you only spend 20, then only 20 comes out of the death benefit.
And the rest stays in?
The rest stays in it for you to use at a later time. And you don't have to, so I always show the lifetime benefits because it's true longevity protection, but there's a lot of different variations, anywhere from a 25-month, which is not a lot, to 50 to 66 months, basically anywhere in between 25 months and lifetime. So if you shorten it, it might give you a bigger pool of money. Yes, sir?
Does the benefit continue after the 10 years is over?
It sure does. It is, in this example, it is a lifetime benefit period. So all that is it's just paid up after year 10. Now, if you need care, here's another great benefit to this particular solution. If you need care in year 5, those premiums are waived. So that $25,000 that goes into the life policy will now go to you as income. Plus, you'll get your long-term care benefit. So it's a really neat solution to be able to utilize qualified dollars. There's only one of its kind. Now we can buy the hamburger, fries, and drinks separately. We can put that together, but they do everything for you here. Set it and forget it. You move it, put it in your lockbox. If you need it, you've got it for care. If you don't, then someone's going to get the death benefit. All right, any additional questions on that solution? Again, I know that's more complex. Just know that we can utilize those dollars, and when you meet with the gang, they can dial it down for you as to what's best for you.
I didn't understand the $25,000 thing.
All right, so the way that it works, you put in $200,000, you get a bonus of 25%. So that would give you $250,000. So then the insurance company turns on an income rider. And basically that comes out of the $250,000 and goes into the life policy. So that $25,000 is an internal premium that comes out to fund the life insurance policy. And that does that over 10 years.
And that's what you're paying the income tax?
Correct, that's what you're paying the income tax on. Does that make more sense?
Yeah.
Great question. The advantage is that there's 101 different ways under the sun to fund these. That's also the disadvantage. It's really, how do you want to fund that plan? You can fund it any way you want. What I'm trying to do here is show you that there are multiple ways to fund these types of long-term care solutions. So this would be a great one for someone who has a ton of qualified money and maybe they don't have that cash sitting in the bank. So that's the only money they have to utilize. So that's when we would go the direction of the qualified versus cash sitting in the bank. Does that make more sense? So again, it's not a one-size-fits-all approach. It really isn't, and I say this a lot, but you just really need to meet with the team because it's, again, we could have 15, 20 different solutions just sitting in here in this room right now because you're all unique and you're different. And it is based on how you want to fund it, how much of a benefit you want, and again, age and wealth. So great questions. Anything else before I move along to the next solution? All right, fantastic. So last but not least, income. So you can stretch these out from a cash flow perspective, again, anywhere from a 5-pay, meaning you pay in 5 years, for example, the $25,000. You can do 25, 25, and 25 and be done. Or you could do a 10-pay, you could do a 15-pay, you could do a 20-pay, or a paid age 100. So from a cash flow perspective, the longer that you stretch those out, the least amount of money that you're going to pay over, that income stream. So here we have an example of a 62-year-old female. She is going to be retiring. She has decided at 72 years old, so she wants to be done. So we're going to put in $14,172 a year for 10 years. Now, the difference between these solutions and the traditional long-term care is you're owning your contract versus renting it. That's the analogy I use. So what do I mean by that? That $14,172 is guaranteed. It is not going to go up versus some of the traditional plans out there. They've kind of gotten a bad rap because I've seen anywhere from 15% to 250% increases on those premiums. So you're, again, owning your policy versus renting it. So what does that $14,172 do? It's going to give her, $6,000 a month for 6 years. So it's not a lifetime benefit here. We're giving her 6 years of coverage. So if she needed care more than 6 years, she would have out-of-pocket expense. That's going to cover probably 95% of all claims. So $6,000 a month, $72,000 a year. That's going to be inflated. So we have added 3% compound inflation, which, by the way, you can add inflation to any of the previous solutions. Conceptually, I just wanted you to understand how they work. She's 62, she may not need care for 20 or more years. So that's why we're adding that 3% compound inflation. That will increase that $6,000 a month and that $72,000 a year. So if she needs care in 25 years, and I think it's 25, I'm not a mathematician, I think it doubles. So now we're looking at roughly $12,000 a month. If she dies and never uses it, we've got a $144,000 death benefit. So basically someone's getting her money back. Again, if we were to put $14,000 in a plain vanilla life insurance policy, you're going to get a whole lot more of a death benefit. This is truly long-term care first. The life insurance is secondary. The whole idea here is if you don't utilize it, then your premiums, or maybe a little bit more, will go to your beneficiaries. So live and need care, $6,000 a month for 6 years. Die and don't need care, $144,000 death benefit. All of these also, I should mention, have a quit benefit. So if you change your mind, the life insurance policies have cash value you can get out, and the annuities will have the accumulation value. So you have, again, all of these solutions provide a living benefit, so live and need care, pennies on the dollar leverage, die and don't need care, death benefit, and then your exit strategy. Does that make sense? This one's probably the easiest to explain. Yes, ma'am?
So it seems like most of the policies you've been sharing have a certain amount of time that you pay on them and then you're paid up. I think the policy we have, you have to continue paying through your lifespan.
Yes. So you can stretch them out, and we see a lot of those. For example, paid age 100, which is most people's lifetime. And the old school or the traditional policies, typically they're all paid forever, paid for life, lifetime pay. But you can, any of these solutions, you can also stretch those payments out if you wanted to.
Okay.
Does that make sense?
Yes, yes it does, thank you. Okay, yeah.
Oh, go ahead, you can ask.
No, it's fine. Any suggestions for how to guarantee you have enough money to continue paying until you die?
That's probably good. I'll let these guys answer that question. It's above my pay grade. Any additional questions on this solution? All right. All right, so next step, set an appointment up. Because again, it's not a one-size-fits-all approach. And by the way, these aren't the only solutions. There are life insurance with chronic illness riders, life insurance with accelerated death benefits, life insurance with LTC riders, annuities with income doublers. There are a number of different solutions out there. These may not, the ones I went over today may not be the right fit for you. But without really sitting down and talking to someone who's a professional and knows what they're doing, we don't know that. So that's why I always encourage you to schedule an appointment, talk about all the different options that are available, dial those down, complete the plan, and if you don't get an insurance solution, here's what I'm going to beg you to do. Have a written plan of care for your family. It is so hard to reactively deal with a long-term care emergency. So tell your family where you want to receive your care, who you want to provide the care, how you're going to fund it. So if you don't ever buy a solution or put a solution in place, know that your money is your plan and share that with your family. If you do complete a plan, share that with your family. Otherwise, your kids are going to take you out back and hose you off. Just kidding. All right, so whatever you do, you have never been younger and healthier than you are today. So I encourage you to do it as quickly as you can. With that, I'll open it up for any additional questions. I'm going to be sticking around too. If you want to come ask me something privately, I'll be here for a while. Yes, ma'am.
I just want to make some comments.
Sure.
I relate this to like term and whole life.
Yes, absolutely. That's a great analogy, term and whole life.
And also, I don't know whether people know what I do taxes, but I found out when my husband died that if I had to pay his funeral out of his estate, I could be used as a deduction.
That is above my pay grade too.
I know, it was mine too. But I just thought I'd throw that out there.
And I'm local too, so if these guys know how to get in touch with me, we
Yeah,
can.
and we've got the presentation, so yeah, that's fine.
The biggest thing associated with this, just like Alecia said, there's 20 different ways to do something, and everybody in this room is different. So it could be a challenge to decide which one's best for you. To be honest with you, I've done this for decades, and I don't make that decision. I walk over to this department right here, and I say, here's the situation we got. Tell me 2 options that are the best fit for this situation. Why? Because they're able to scan hundreds of different companies and say, okay, this is it, and this is why. So that's why we utilize Alecia and her crew as far as FIG to bring us solutions in regard to what we present to you. But she mentioned traditional long-term care. We're not a fan. We'll be first to tell you, it'd be our last option. Asset-based and then hybrid plans utilizing life insurance would be our top 2 choices. Why? Because the premiums can't change. We'll never have a discussion that your premium's going up. That's why we look at those first.
And a lot of the questions about how to fund it is, it depends on your situation, right? When she said 10 pay, that means you pay them for 10 years, it's gonna be a much higher dollar value you're gonna put in there per year versus if you pay it annually for a lifetime or at age 100, like she mentioned. So it's kind of a cash flow situation. Not a lot of people have 200 grand sitting around, they can just dump into an asset-based policy and be good, right? Some people do, some people don't. So it really depends on the situation, on how you structure it, how you pay for it. So that's why there's a lot of, there's tons of options out there. We just gotta look and see what's fits you best.
And it's really running the options per couple or individual that we're working with. Sometimes, like for instance, my solution, I did a 7 pay and I was done. But that may not fit you. You may want to do a lifetime of 100 pay. I don't know, but I did a 7 pay. The reason I did is I had a health scare. So I knew I was taking that question mark off the table when it came to my financial plan.
And the yellow spot up here talks about the you will never be younger or healthier than you are today. That's massive. A lot of people put this stuff off, and like you say, you're not getting any younger, you're not getting any healthier. Life insurance, some of these annuity-based plans, they do look at your health. So a lot of people start asking, usually people don't, if people come ask us about this stuff, they've either experienced it through their life and helping a parent, and they just know how bad that was, they don't want their family to deal with that, or something's come up with them health-wise and they want to try to get something in place. But it might be too late to look at it at that point in time. We've had a situation where we put this in place for someone, and I think 3 months later he had a massive heart attack and wouldn't be able to qualify for it anymore, but he already had it, they can't take it away from him. Because he was healthy back when he got it, right? So, timing is good as well. And just don't put it off if you're interested in it. So,
And I think I've got
That's
it.
huge.
Yes, ma'am.
Just a quick question. Set up the appointment, is that with you guys?
That's with
And
us.
you guys go to, all right.
Yeah. Basically, you've got the survey forms with you. If you have an interest in setting an appointment and talking about long-term care, it'll be Brandon, myself, or Scott. We'll get you with one of the 3 of us. We'll talk about it and see if it's a good fit for you. Because like I said, everybody in here is different.
Yeah.
And
And it's not a
everybody's
fit for everyone either, so know that too.
Hey, and that's one of the things as certified financial planners that Brandon and I focus on. If we talk about it and we try it, we look at it, it doesn't fit into your financial situation, that's perfectly fine, but you know what? We're gonna document that we looked at it. And we tried to set a solution up, it just wasn't available. So where do you go then? We shift over and start doing Medicaid planning at that point.
All right, any other questions? All right, well, thank you for letting me speak today. Appreciate it.